15 minutes. That is the exact amount of time the average American spends per week managing the financial accounts that are supposed to carry them through 20 or 30 years of retirement. 15 minutes total, across all accounts, all decisions, all course corrections, and the number the Federal Reserve Survey of Consumer Finances publishes for median retirement savings among Americans aged 55 to 64 is $185,000 against the $1.46 million. The same surveys show Americans believe they need. That distance is not a discipline gap. It is a system gap. And by the end of this video, I'm going to give you a 3-part protocol called the MAP method, 15 specific minutes per week, organized into a structure that closes that gap faster than any savings rate increase alone can manage. My name is Pierce. I have spent 25 years as an accountant, corporate tax, small business books, individual returns, audit prep. 25 years of looking at the inside of other people's financial lives, not their budgets in theory, but their actual numbers, their actual accounts, their actual tax returns, year after year. In that time, I have watched a pattern repeat itself so reliably that I stopped being surprised by it. The people who retire with genuine financial security, the ones whose accounts do what they were supposed to do, are almost never the people who worked harder than everyone else or earned more than everyone else. They are the people who spent a specific kind of time on a specific set of decisions. Not more time, a different kind of time. And the people who arrive at my desk in their early 60s with the wrong numbers are almost never irresponsible. They are people who spent 20 or 30 years doing exactly what they were told to do, checking the right boxes, without anyone ever explaining what those boxes were actually measuring. Here is the number that almost nobody calculates. If you are contributing $24,500 per year to a 401k in 2026, the Internal Revenue Service confirmed that as the limit this year, up from $23,500 in 2025, and your account earns 7% annually, which is a conservative number by historical standards, and I will show you exactly how conservative in a moment. Your account needs to reach a balance of $350,000 before the annual growth. It generates matches what you are contributing from your paycheck. $350,000. Below that number, your contributions are the primary driver of your account's growth. Above it, your existing money is growing faster on its own than you can add to it manually. That is not a philosophical point. That is arithmetic. Divide your annual contribution by your expected return rate. 24,500 divided by 0.07 equals 350,000. That number is the line. Most people have never drawn it on a chart. The financial services industry has a structural reason not to draw it for you. We will get to that reason shortly. The 7% figure deserves a direct explanation before we go any further, because every projection in this video rests on it, and you deserve to know what it is and where it comes from. The long-run annualized real return of a broadly diversified United States equity portfolio after adjusting for inflation has historically been estimated in the range of 6 to 7% by academic researchers including Eugene Farmer and Kenneth French at the University of Chicago. The nominal return, before inflation adjustment, has historically been closer to 10% annualized over rolling 20 and 30-year periods, according to data maintained by Dimensional Fund Advisors and cited repeatedly by the SPIVA Scorecard published annually by S&P Dow Jones Indices. Using 7% is conservative. It accounts for the possibility that your portfolio includes a bond allocation or that your net returns are modestly lower than the index. When I say a 7% return, I'm describing a number that the historical record suggests most disciplined investors in low-cost diversified index funds can reasonably expect over a working career. I am not guaranteeing it. Nobody can. But I am not making up a number. I am citing the same data set that serious researchers have used for decades. Now let me show you what the 15-minute gap actually costs. Not the gap between rich and poor. The gap between 15 minutes spent the wrong way and 15 minutes spent the right way. Because the issue is not that people are spending no time on their retirement. The issue is that the time they spend is concentrated on the decisions with the smallest mathematical impact and almost none on the decisions with the largest impact. Think about a commercial kitchen running dinner service. Every cook on the line is moving constantly, chopping, plating, adjusting heat. The kitchen is genuinely busy. But if the chef never updates the menu, never reviews which dishes are the most profitable, never adjusts the food cost ratios, the restaurant can be busy all year and still lose money. The activity is real. The energy is real. What is missing is not effort. It is the specific 15 minutes per week the chef spends reviewing what the activity is actually producing. Your retirement accounts work the same way. The contributions arrive. The market moves. The balances change. But most people never spend structured time reviewing whether the decisions behind those movements are the right ones. And that absence, not laziness, not irresponsibility, a specific structural absence, is where the damage accumulates. Here is the proof in two parallel numbers. A 45-year-old contributing $6,000 per year to a 401k in a fund with an annual expense ratio of 1.1%, which is near the simple average for actively managed equity mutual funds according to the 2024 IFS research data, and earning 7% gross on investments, will accumulate approximately $423,000 by age 65. The same 45-year-old making the identical contribution to a fund with an expense ratio of 0.04%, which is what Vanguard currently charges on the Vanguard Total Stock Market Index Fund, and earning the same 7% gross, will accumulate approximately $514,000 by age 65. The only variable that changed was a number printed in the fund's prospectus. That number, expressed as a percentage, cost the first investor roughly $91,000 over 20 years. That is not a market risk. That is not a bad year. That is a structural leak in the account that ran silently for 20 years and never produced a notification, never generated a separate bill, never appeared in the transaction history as a withdrawal. The fee was always there. The investor just never spent 15 minutes finding it. People over 50 face this in silence because the compound damage of 2 or 3 decades of excess fees is already done by the time someone reviews their statements carefully for the first time. The window to prevent the damage has closed. What remains is the window to stop it from continuing. And that window is still open. Now let me introduce the invisible villain, because the 15-minute problem does not exist in isolation. It exists inside a system specifically structured to make those 15 minutes feel unnecessary. We have been told for decades that retirement security requires one primary thing: saving more, contribute more, automate more, maximize the limit, get the full employer match. The message is consistent across employer HR presentations, financial media, and bank-produced retirement planning worksheets. It is not wrong, but it is incomplete in a way that costs people real money over a working lifetime. The Save More message is the only message because the Save More behavior generates assets under management, and assets under management generate fees. The conversation about what happens inside the accounts, how those assets are structured, what they cost, whether they are positioned correctly for where the investor actually sits on the contribution to growth curve, that conversation is not in anyone's economic interest to start except yours. The SPIVA Scorecard, published by S&P Dow Jones Indices and representing the most cited measurement of active fund performance in the industry, found that over the 15-year period ending December 2024, not a single United States equity fund category, 0 out of 22, had a majority of active managers outperforming their benchmarks. Over the 20-year period from 2005 through 2024, 94.1% of all domestic funds underperformed the S&P 1500 Composite Index. Not 1 year, not a rough patch. 20 years, thousands of funds, every market condition available, and the overwhelming conclusion is the same every time. The professionals being paid to select securities cannot beat the index those same securities belong to after their fees are accounted for. I read prospectuses. That is the job. And I can tell you that the fee disclosure language in most fund documents is written to be technically compliant and practically invisible to anyone not specifically looking for it. I want to tell you about a client I will call David. Not his real name, but his numbers are real. David came to see me at 61 years old. He had worked in logistics management for 32 years. He had contributed to his 401k every single year, never missed an enrollment window, always got the full employer match. He described himself, unprompted, as someone who had always taken retirement seriously. His total 401k balance was $640,000. By almost any standard measure, a genuine success. He was proud of it. He had a right to be. Then I pulled his account history and asked him one question. What are the expense ratios on the funds inside this account? He looked at me the way people look at a doctor who asks something they feel they should know the answer to. He said he thought it was something small, something automatic. He had never looked at the number directly. The funds in his account had an asset-weighted average expense ratio of 0.93%, not unusual for a plan that defaulted employees into actively managed options in the early 2000s and was never updated. We calculated what his balance would have looked like if those same contributions, the same employer match, the same market return had been in a comparable index fund at 0.04% over the same 32 years. The difference was not small. It was not a rounding error. It was approximately $178,000 in terminal wealth. He had paid those fees for 32 years without receiving a single bill for them and without anyone inside the plan ever flagging them as a variable worth his attention. He did not cry because he was ruined. $640,000 is more than the median retirement savings for Americans aged 55 to 64 by a factor of more than 3, according to the Federal Reserve Survey of Consumer Finances. David was doing well. He cried because nobody in 32 years had asked him to spend 15 minutes finding that number. The fee was legal, disclosed, and completely invisible in practice. That is the system working exactly as designed. Here is the anti-diagnosis, and I want to be direct about this because it matters. The problem David had is not a discipline problem. It is not an income problem. It is not a financial literacy problem in the sense that David lacked general intelligence or curiosity. David is a smart person who received incomplete information from a system that had no economic incentive to complete it. Your behavior is correct. The system is not. The real problem is not what you think it is. Most people who feel behind on retirement savings believe the problem is that they have not saved enough or started too late. But the problem that shows up most consistently in actual client folders is simpler and more fixable. The decisions with the largest mathematical impact, expense ratios, tax location, the crossover threshold, the sequence of withdrawals, receive almost none of the attention people give to retirement. The decisions with the smallest impact, watching balances change daily, reading market commentary, receive almost all of it. This is not a discipline problem. It is a math problem, and specifically, it is a time allocation problem. Nobody built David a map of which 15 minutes per week would actually move his outcome. That is what this video exists to do. The mainstream betrayal I described with David is not unique to his plan or his employer. It is structural. Here is the number nobody put on the chart. According to data compiled by the Investment Company Institute, Americans hold approximately $11 trillion in 401k accounts. The asset-weighted average expense ratio for actively managed equity mutual funds was 0.40% in 2024, while simple average expense ratios across the industry reached 1.10%. The gap between what investors pay in the average plan and what they would pay in a Vanguard Total Stock Market Index Fund at 0.04% represents tens of billions of dollars annually flowing from American retirement accounts to fund companies. That flow does not appear on any statement as an outgoing wire. It does not generate a year-end tax form. It simply does not compound forward for you. The financial services industry knew this and said nothing, not because the people inside it are individually dishonest, but because the incentive structure does not reward the conversation that would reduce its own revenue. The window between when something is visible to those paying attention and when it becomes obvious to everyone is where generational wealth is built or lost. Now let me show you exactly what the right 15 minutes per week looks like. Not in theory. In practice, with specific numbers and a specific order of operations, this is the MAP method. M stands for measure, A stands for allocate, P stands for protect. Each component takes 5 minutes per week when the system is running correctly. The first time you run it, it will take longer. That is fine. You only build the system once. After that, you run it. M is for measure. 5 minutes per week, every week, on the same day and at the same time. You open every retirement account, your 401k, your individual retirement account, your Roth individual retirement account, any rollover account from a previous employer, and you record 3 numbers, your total balance across all accounts, the expense ratio of every fund you hold in every account, found in the Fund Details tab of your brokerage platform, or by searching the fund's ticker symbol at morningstar.com, and your current crossover threshold, calculated as your total annual contributions, including employer match, divided by 0.07. That third number is the line. If your total balance is below your crossover threshold, contributions are your primary lever. If your total balance is above it, growth rate, meaning what your funds cost and how they are structured, is your primary lever. Most people have never calculated this number. According to the Employee Benefit Research Institute's 2025 Retirement Confidence Survey, only 28% of American workers are very confident they will have enough money to live comfortably in retirement. That gap between contributing and confidence is not primarily a savings gap. It is a measurement gap. People do not know what they have relative to what they need because nobody gave them a number to calculate every week. 5 minutes per week closes that gap. You always know where you are on the curve. You always know which lever matters most right now. The measurement creates a feedback loop that contributions alone never produce. People over 50 especially need this number because the crossover math changes once the threshold has been crossed, and generic save more advice is structurally wrong for the growth dominance phase that follows. A is for allocate. 5 minutes per week reviewing whether the money inside your accounts is sitting in the right place. Specifically 3 things. First, is every fund in every account the lowest cost option available for that asset class inside that plan? If your 401k offers an S&P 500 index fund at 0.02% and you are currently in an actively managed large cap fund at 0.8%, that is an allocation problem that 5 minutes fixes permanently. You change the allocation, set future contributions to the index fund, and the leak stops. Second, is the money in the right type of account given your expected tax situation in retirement? The distinction between a traditional pre-tax 401k and a Roth 401k matters most between now and the moment your required minimum distributions begin at age 73, or 75 for those born after 1959 under the changes made by the Secure 2.0 legislation. If your traditional account balance is tracking toward a required minimum distribution that will push you above the Social Security torpedo threshold of $44,000 in combined income for married couples, filing jointly under the Internal Revenue Service's current combined income formula, the Roth allocation question is worth 5 minutes per week right now, not at 68. Third, is any cash sitting in a money market or stable value fund inside your retirement account earning less than what a high-yield savings account would pay outside the account? As of early 2026, competitive high-yield savings accounts are offering around 4% on cash. Safety that does not beat inflation is not safety. It is slow wealth destruction. If your 401k default option is a stable value fund at 1.8%, that is a 5-minute reallocation question, not a research project. P is for protect. The 5 minutes per week that almost nobody spends and that produces the largest long-term differential of the 3 components. Protecting the system means reviewing exactly 1 account decision per week that could interrupt the compounding process if left unexamined. The list of decisions rotates through a fixed schedule. Week 1, confirm your employer match capture rate. If your employer matches 50 cents per dollar up to 6% of your salary, and you are contributing 4%, you are leaving money on the table. That match is an immediate 50% return before the market does anything. No investment can replicate it. This takes 4 minutes to check in your HR portal and approximately 90 seconds to correct if needed. Week 2. Check whether any fund in your account had a material expense ratio change in the past quarter. Plan providers occasionally swap fund options or change fee structures without notification. The change will not trigger an alert. It will simply start costing more or less without explanation. Week 3. Verify your beneficiary designations on every account. An outdated beneficiary designation on a 401k worth $300,000 will override your will, override your estate plan, and send that money to whoever you named when you were 28 and had different circumstances. 4 minutes to check. 1 minute to update if needed. Week 4. Review your asset allocation relative to your actual time horizon. The default target date fund, assigned at enrollment, was built for a generic retirement date, not for your specific income replacement needs or actual risk tolerance. It is a starting point. 5 minutes to compare your current allocation to where you actually want to be. Now let me tell you the one common mistake that invalidates the entire MAP method if left uncorrected. Because this is where most people who start the protocol abandon it, and where the damage they were trying to prevent quietly continues. The mistake is running all 3 components in the first week and then drifting back to the old pattern. Not because they forgot to care, because the system has no external accountability mechanism unless you build one. 15 minutes per week sounds trivial, and it is trivial when everything in the system is correct. When your funds are indexed, your employer match is fully captured, your beneficiaries are current, your allocation matches your timeline, and your crossover threshold confirms you are in the right phase. In that steady state, 15 minutes per week is genuinely all this requires. But the system only reaches that steady state if you spend the first 4 to 6 weeks building it from scratch, correcting the fee structure, updating the allocation, calculating the threshold, and writing the number down somewhere you will see it again next week. The mistake is skipping that foundation building phase, checking the account balance once, deciding everything looks fine, and returning to 15 minutes per week of the wrong kind of attention. The account balance is the least informative number in your retirement picture. It tells you what you have today. It does not tell you what you are paying for it, whether it is growing at the rate the market is delivering, or whether the structure of the account is positioned correctly for where you are on the contribution to growth curve. Watching the balance is the financial equivalent of checking the fuel gauge every 5 minutes without ever opening the hood. The MAP method is not about the balance. It is about the 3 variables that determine what the balance becomes over the next 10 or 20 years. And those variables require a specific, structured kind of attention that the balance screen was never designed to provide. Let me close David's story the right way. Because I introduced him for a reason and not just to illustrate the fee mechanism. After we calculated the $178,000 gap between what his account was and what it would have been in a low-cost index structure, we did something that mattered more than the calculation itself. We moved forward. David was 61 with $640,000. He had at minimum 4 years, likely longer, before he planned to stop working. We switched his existing balance and all future contributions to the lowest cost index fund available in his plan, an S&P 500 fund at 0.03%. We built a MAP schedule for him on a single piece of paper. Monday morning, 5 minutes, same every week. We calculated his crossover threshold, $640,000 with a combined annual contribution of approximately $30,000, including employer match, puts his crossover number at $428,500. He crossed it years ago. His primary lever is growth rate, not savings rate, which means every fee dollar he recovered was worth more than an additional contribution dollar at this stage of the curve. Over 4 years of continued growth at 7% with corrected fee structure and continued contributions, his projected balance at 65 crossed $900,000, compared to approximately $790,000 if he had stayed in the old fund structure. The difference between the two paths from age 61 to age 65 is not 32 years of accumulated damage. It is 4 years of corrected decisions. That is what the MAP method produces. Not a miracle, a correction, applied consistently, starting the week you build the system. Now let me give you the cost of not starting this week, not this month, this week. At 7% annual growth, and again, that is a conservative estimate relative to the historical 10% nominal long-run return of the United States equity market, used here to account for bond allocations and realistic portfolio composition. A 401k balance of $350,000 grows by $24,500 in year 1. That is exactly equal to the maximum annual contribution limit the Internal Revenue Service set for 2026. Every 12 months you delay correcting an expense ratio problem, at that balance costs you not just the fee differential for that year, but the compounding of every dollar that fee removed in all the years that follow. I am going to prove this with numbers. The difference between a 0.93% expense ratio and a 0.04% expense ratio on a $350,000 account is $3,115 per year. Over 10 years at 7% growth, that $3,115 per year in recovered fees compounds to approximately $43,000 in additional terminal wealth. Certainty never arrives before the price does. Waiting until you feel absolutely sure the system is worth building costs $43,000 over 10 years on a mid-range account balance, before accounting for the larger balances those same dollars compound into by retirement age. That is not the cost of ignorance. That is the cost of delay after the information is in front of you. And people over 50 have the shortest runway to absorb that cost, which means the first week of MAP execution is worth more in actual dollars for someone at 55 than for someone at 35. The math of compounding is not fair about timing. It simply runs. Here are the specific numbers that make the MAP method executable right now, this week, without any ambiguity. The Internal Revenue Service confirmed the 401k contribution limit for 2026 at $24,500. If you are age 50 or older, the limit increases to $32,500 with the standard catch-up contribution. If you are between 60 and 63 years old and your plan allows, the Secure 2.0 Super Catch-up brings your total to $35,750, the highest contribution ceiling currently available to any American worker. That 60 to 63 window is one of the most underused provisions in the current tax code, and one of the most powerful, because contributions at peak earning years go in at what is likely your highest marginal rate and come out in retirement at a potentially lower one. The Roth Individual Retirement Account contribution limit for 2026 is $7,500, or $8,600 if you are age 50 or older. For single filers, the income phase-out range begins at $153,000. For married couples filing jointly, it begins at $242,000. Below those thresholds, you can contribute the full amount. Above them, the backdoor Roth Individual Retirement Account conversion remains a legal and widely used mechanism, though it carries pro-rata tax implications if you hold existing pre-tax individual retirement account balances that a licensed tax professional needs to evaluate before execution. These are not abstract limits. These are the actual numbers the Internal Revenue Service published for this year. They belong in your MAP system as fixed reference points that you review in the measure component every week. The MAP method works because it solves the right problem. The right problem is not that Americans are undisciplined or uninformed in a general sense. The right problem is that the financial decisions with the highest mathematical impact on retirement wealth are invisible by design, buried in fund prospectuses, distributed across multiple accounts, expressed in percentage terms that translate to large dollar figures only when someone sits down to do the arithmetic. MAP makes them visible consistently, in 15 minutes per week. Measure tells you where you are on the curve and which lever matters. Allocate confirms the money is in the right structure at the right cost in the right account type. Protect reviews the 4 decisions per month that, if neglected, can interrupt 20 or 30 years of compounding in ways that no subsequent contribution can repair. The number that changes everything is not your balance. It is the ratio of your balance to your crossover threshold. That ratio tells you whether you are still paddling against the current or whether the current is now stronger than the paddle. Most Americans do not know which side of that ratio they are on. After 15 minutes with the MAP method, you will. If you are going to run the MAP method on your own accounts this week, and I mean actually opening the statements, finding the expense ratios, and writing down your crossover threshold before you close the browser, comment MAP below. That is the filter. Not who watched, not who agreed, not who intends to. Who opened the accounts. Subscribe to this channel, because next week I am going to show you what happens to the math inside a 401k during the decade immediately before retirement, the sequence of returns window, and why the decisions made in that specific 10-year stretch determine more of your retirement outcome than any other decade in a working life. This content is for educational purposes only and reflects publicly available financial data, including figures from the Federal Reserve Survey of Consumer Finances, the SPIVA Scorecard, published by S&P Dow Jones Indices, the Employee Benefit Research Institute, and official Internal Revenue Service publications. Every financial situation is different. The projections in this video use a 7% annual return as a conservative estimate and are not guarantees of future performance. Before making investment, tax, or retirement decisions, consult a licensed financial professional, a certified public accountant, or fee-only fiduciary financial planner, who can review the specifics of your individual circumstances. Nothing in this video constitutes personalized financial advice.